back with another action-packed live. We're going to be doing a market update today, 2023. I'm going to tap you guys into what's going on in the market. Is now a good time to invest in real estate? Where are interest rates headed? Are there new strategies that we can tap into to put down very little money to invest in real estate? So I'm going to break down a lot for you. Make sure you stick around to the end. Ask lots of questions. We're going to be doing live Q&A. So leave your questions, comments in the chat section. Even if you're watching this after the live, make sure you leave a comment or a question. We'll get back to you. Make sure you guys like, comment, subscribe. Leave a comment that says I subscribe. For everyone who leaves that comment, I'll send you instant access to my free real estate training. It'll show you how to acquire properties for pennies on the dollar all across the country. You don't want to miss out on that free offer. So guys, let's get into this. One, I want to talk about a little mindset hack that you always need to focus on as a real estate investor, because the market is always ebbing and flowing. It's always doing something. It's how I explain it is it's like a river. If you step in a river, there's a famous philosopher who says you can never step into the same river twice because it's always flowing. It's always in motion. It's always different. The real estate market is always different. So you don't want to bet on one strategy to get you there. There's a lot of talking heads in real estate. There's a lot of gurus. I'm not a guru. I'm a mentor. And I'm just Brian, right? But there's a lot of talking heads that are going to tell you there's one strategy that's going to get you there. It's if you got an extra bedroom, it's Airbnb, or it's buying and flipping, or buying and holding, or creative financing. That's the only way to make money. The truth is there are multiple ways to make money in real estate. There's 101 ways, and you need multiple strategies to accelerate yourself, to advance in this game. Because the market is constantly changing, you need enough strategies, at least 5 or 6 core strategies that you can pivot to as the market is changing. Because even if buying and flipping is good this year, or Airbnb is good this year, next year it may not be. And you don't want to be out of the game or get sidelined or get your whole portfolio crushed because you don't know how to do any other strategies. You also don't want to have to tap into, a different mentor because you don't know what's going on and they can only teach you one thing. And that's why, we focus on multiple strategies within 100 Keys Masterclass, within our one-on-one VIP mentorship program. The real mindset hack, though, I want to talk to you guys about is this fail forward mindset hack. I'm talking to a lot of people that are just getting into deals. It might be their first deal, it might be their 5th deal, but they're getting into a deal and they're nervous and they're afraid. And they're like, well, what if this doesn't work? Like at first, you're going to be excited about your new deal. And then you're going to get into this mindset of what if it all kind of goes to hell? Like, what if it doesn't work out for me? What's going to happen? What you have to do is fast forward to the worst case scenario. In most of these instances, the worst case scenario is you lose $10,000, $15,000 on the deal. So just take it there. Hey, I'm going to do this deal. I'm going to try to flip it. It's not going to sell. I'm going to lose some money on this deal. And then what happens is my question. Because I've seen people do deals that I would say are not good at real estate. They lose $50,000, $100,000 on a deal. And I fast forward 5 years because I've known, a lot of developers for a long time, and they're up $500,000. They're up $1 million because they stuck with it. They failed forward because they looked at the real estate game holistically. In real estate, a $10,000 or $15,000 loss can be recovered very quickly. It can be recovered on the very next deal. So you should not necessarily be concerning yourself on whether or not this one deal is going to be the most profitable deal you ever did and is going to make money and is going to be a slam dunk. There's always a risk reward premium in real estate. But if you stay in the game and you keep going and you keep getting better and making updates and tapping into mentorship and learning more, and you stick with this game for life and understand that your alternative is being stuck in a 9 to 5 forever, that's like a guarantee, you will start to reap the rewards of real estate. There are more ways to win in this game than you even know. You don't even understand the tax implications of how you could lose on a deal, but recover that on taxes and get a tax return. You don't understand the true value of real estate yet because you haven't owned it long enough. You haven't lived it long enough. But the only way to really lose in this game, both short term and long term, is to not play, is to not get in and not learn, to sit on the sidelines and think you're going to be the smartest person who can wait out the market and perfectly time it. You're not. There is no timing of the market. It's always moving. What you need to do is learn the game and have multiple strategies so that you can navigate any real estate market. Because in every real estate market, there are professionals making money. And there, in every real estate market, there are people sitting on the sidelines and naysayers. In every market, the people who sit on the sidelines, they never win, quite frankly. The people who play, they almost always win. I mean, look at the statistics of real estate. It makes most of the world's millionaires, and it has a high success rate. I think people who stick with it, about 80% are profitable in real estate. There are no other businesses like that. Most businesses, 9 out of 10 fail. That's not the case with real estate. So make sure you guys stay tapped in. Like I said, like, comment, subscribe. And I want to get into this. Ask your questions as we go through this. I will stop to answer questions live. But first, I want to start off with something that, look, guys, this just came out about a week ago in late May. So we have some large lenders that are rolling out these 1% down mortgage payments. And if you're sitting on the sideline, you'll miss out on this, right? Because you're saying, hey, I'm going to sit on the sidelines. I'm going to wait to learn, and I'll wait for the market to be good. Well, guess what? For the people who are already in the masterclass, who've already learned and are already in striking distance for deals, they can go out and tap into this type of 1% down mortgage payment loan right away, grab a deal right away, while you're now trying to figure out how to get into the game. And this is why you need to stay ready. The best way to get ready is to stay ready. So Rocket Mortgage, the largest lender in the US, in the nation in 2022, announced its 1+ loan program this week. This was last week. United Wholesale Mortgage, the number 2 lender, launched its conventional 1% down loans in April, then made them significantly more generous following Rocket's announcement, because Rocket kind of stepped it up a bit. These are the 2 largest lenders in the nation. So what are these 1% mortgages? They said the rival programs piggyback off of Fannie Mae's Home Ready mortgages and Freddie Mac's Home Possible loans. Those initiatives allow borrowers who make less than 80% of their neighborhood's median income to obtain a conventional loan with just 3% down. But now they're kind of stepping it up a notch. So how do these work? To make the 1% down a reality, both lenders cover 2% of the 3% down payment needed to obtain a Home Ready or Home Possible mortgage. The borrower only supplies the remaining 1%. So for a lot of us who are saying, I don't have the cash to get in. I told you guys, there's 2 things in real estate: knowledge and money. The less you have of one, the more you need of the other. So if you have less capital, but you have knowledge of how to leverage a 1% down payment deal or mortgage, that knowledge is worth more than the money, isn't it? So knowledge always rules supreme. KRS-One, if you guys are old school rap fans, but knowledge rules supreme. You have to learn about this real estate game. You have to stay tapped in, because these things are coming out. Like, this stuff just came out a week ago from the largest lenders in the nation, and you guys can start tapping in to get into your first deal. This is what's cool about Rocket. Rocket's program also covers private mortgage insurance, the PMI, at no cost to the borrower. Typically, lenders require borrowers to pay these insurance premiums if their down payment is less than 20%. On a $242,000 loan, those premiums can run about $245 a month. So when they're covering that, what that means for you is more cash flow, more cash in your pocket, even when you're going out and leveraging these 1% down payment type of mortgages. I mean, this stuff should be shocking. My guy, Antonio, said, wow, yeah, this stuff is crazy. This is insane. And I've been telling you guys in previous market updates that the mortgage market, it will adapt to higher interest rates. So as rates go up and different things happen, they're going to keep creating new products to meet demand. They're going to try to increase demand. And this is one of them. So let's talk about some of the income limits, because they did break that down. So here's some of the income limits. To qualify for the 1% down programs, or any Home Ready or Home Possible loan, you can't make more than 80% of the median income in the area where you're buying. Those figures vary widely throughout the US. Here are a few examples. So we have Atlanta, which a lot of you definitely are calling me from Atlanta. I'm talking to a lot of you guys. So if you're making less than 76K in Atlanta, you're in. Chicago, definitely have a large Chicago following for the 100 Keys Masterclass and this channel. 85,000 about Dallas 76, New York City, all my New Yorkers, and I'm out in New York with you guys. You're making less than 90K, you can get in. San Francisco, if you're out on the West Coast, 120,000. And these aren't the only places. So if you're anywhere around these places, you're probably going to match up with these income levels. And this is, I would say, the majority of you. The majority of you are working 9 to 5, making these levels of income, and you can qualify for this stuff. So yeah, lovely Leo said this is shocking. It's shocking, but this stuff is happening. This is why I tell you guys, you have to get ready. Whenever I hear I'm just sitting on the sidelines, I'm waiting out the market. No. Learn how to invest in real estate. The other thing about this is really cool, because I was on this wavelength. Is there a catch? These programs are a sweet deal for borrowers, so much that there's no guarantee the terms will stay the same. So the catch is, this thing is going to be here until people start really tapping into this, and they might just pull the rug and just take it off the table. This is why another reason why you can't wait, because when these programs come, they're going to be good. People are going to tap in and make profit, and then you're going to miss it because you're not ready. You haven't been tapped in. A lot of us don't know. I've heard people say, like, I'm going to wait out the market. And trust me, I dig it. I understand the sentiment. But then I've had people join the VIP mentorship program, where I get to work with you guys one-on-one and educate you on this game and help you to get into a deal within 90 days, which is the goal. And I'm like, wow, some of you can't run comps yet. You don't know how to do market research. You don't know how to generate cash flow, or how to property manage, or how to do so many steps. So don't get caught up thinking you can wait out the market. But then even if the market was ready, you still don't know the steps to go out and execute on a deal. You have to learn before you think you're ready, for most of us, because most of us will never think we're ready. It's the truth. We'll never feel ready, because there is no feeling of readiness in this game. You're always nervous. You're always afraid. You're always unsure. It's part of the game until you get more experience and learn and around those bases. There was one other thing here that I wanted to touch on. You can buy these not only as a first-time home buyer, because that's another question a lot of people will have, is like, do I have to be a first-time home buyer? No, you could actually get this for a second home as well. So you don't even have to do this as the first-time home purchase, which is very interesting. So this is something for a lot of us we can tap into if we're just getting started out, little to no cash, no credit. Guys, like, comment, subscribe. If you think there's somebody in your circle that could benefit from some of this information, definitely share this video with them, because a lot of people will never hear about this stuff. They're not doing the research. If it's not presented to them, they're just not going to find it. So definitely share this video, like, comment, subscribe, leave the comment that says I subscribe, so I can send you guys instant access to that free real estate training. It'll show you how to acquire properties for pennies on the dollar all across the country. And keep your questions going. Keep your questions coming so that we can answer you guys' questions. Let's get into some more of these market updates. I definitely want to touch on interest rates too, so stick around to the end for some of that. Workers, there's a lot of question about what's going on with the market. Is commercial real estate really good? This is from the Washington Post. Commercial real estate is kind of taking a bath here. Like it's a bloodbath in commercial real estate. Commercial real estate crisis in cities like San Francisco is spiking, but brokers say the real impact of remote work and low office occupancy won't be clear for 4 months. I'll get back into this. We got a quick question, which is, can someone use the 1% down payment Yes, for investment property. Yes, you can. Because you could even use this on a multi. There is an income. I mean, there is a loan amount limit. The loan amount limit is $350,000, but they're pretty much stepping in and allowing you to do this. I mean, even if you're doing something like a single family residence with 3% down, I mean, most of these properties, let's say even if you FHA'd this on a duplex, triplex, quadplex, live in one unit for a year, rent out to others, or some people will try something a little craftier, like, I'm gonna keep one unit open for me, then they'll live in it a little bit, Airbnb it a little bit, generate more income, and kind of keep flowing. So, there's a lot going on there, but you can definitely get investment properties with this. If you don't know how, guys, definitely tap in. Ace Deuce has already tapped into the masterclass, so we can talk about it if it's something you want to try to leverage. But guys, we got to research this stuff. We got to go out and tap into this stuff. Pharaoh said the internet is killing commercial. It seems, yeah. I mean, commercial is getting crushed. So I think it's fair. I think it's really fair. So what's going on is we had it. People just aren't going back since the pandemic. Employers, particularly in major cities, have been struggling to get their workers to return to the office, while others have given up and allowed workers to go fully remote. That trend is finally starting to catch up with the owners of office buildings in the form of rising vacancy rates and declining property values. So earlier this month, data came out that an estimated 270 billion in commercial bank loans are coming due in 2023 and warned of the potential for defaults. So what's going on in this commercial game is, I've been explaining this to many of you guys, but the commercial loans are not 30-year fixed mortgages like you can get on a residential. For a commercial loan, they do a 30-year amortization table, but it's a 10-year loan with a balloon payment at the end of 10 years. So these typically get refinanced. Commercial real estate historically will appreciate, and it's been a safe bet because you had the office. I mean, for the last 50, 60 years, the office has been the office. You even have the show, The Office. Like it is what it is. But now people just want to work from home or work remotely. And even I think employers are starting to see the cost of maintaining the office, especially when it's vacant, is ridiculous in some of these major cities. It does not make any sense. So as these loans come due, they're going to default. The banks, the small banks in America, hold about 60% of this debt. So as these loans continue to default, a lot of banks are going to be in trouble. And we're just going to keep seeing that downward spiral. It's going to be a big thing in the industry. I anticipate, if we're getting future thinking, and I know some of you are thinking like, Brian, is this an opportunity? I would anticipate that you will get some type of pushes on zoning where people are campaigning for the zoning boards to allow some of these buildings to be transitioned into residential. So they will allow somebody to buy this office building and like build condos out of it. With that being said, even if you go in and try to build condos in these things, there's asbestos, there's a lot of commercial grade stuff in these buildings that would have to get remediated at a massive scale. And that stuff costs a lot of money. So it's still not necessarily a safe bet for you to run in and try to do one of these deals, in my opinion. Even if you could buy an office building cheap, the renovation costs and the remediation costs that you would run into could be prohibitively expensive. So it's something that you should definitely be concerned about. We had some questions come through. Let me jump into some of these. How can I check if Arkansas, Charlie, my man Charlie just tapped into the mentorship program. Very, very young, still in college, but very focused on real estate. We're going to try to make him, a millionaire real estate investor before he hits 30 is the goal, to keep him out of that 9 to 5. Just reach out to Rocket. Just call Rocket Mortgage. They got an 800 number. They have like a chat function. Reach out to them. I would anticipate that this is national because they're the biggest, national lender. They're definitely in all 50 states. So just reach out to them and tap in. Ace Deuce said, I answer your question. Sometimes my rants, this is why people love when I go on these rants, because when I go on a rant, it can answer a lot of your questions, even if I don't see it. We already answered that one. We had a question of homes with equity. I didn't see the first part of that question. Maybe expand on that a bit. Can you get money to do the repairs with the loan? You can definitely do an FHA 203K. I'm not sure how that plays into this One Plus, but that's a good question to reach out. Like you guys, I'm leading you to the fountain. You guys should be reaching out to Rocket Mortgage like ASAP and investigating this thing for yourself. I would anticipate there will be an opportunity to do a 1% payment with a FHA 203K where you could buy a triplex, a quadplex, do renovations to it, and get it financed at the 1%. The only issue is that there's that $350,000 loan amount maximum. So if you try to do this on like a 4-unit, in most markets, you're going to get priced out of that, right? Tia said, this is at Rocket Mortgage. This is at Rocket Mortgage. All of my masterclass people who've been kind of wait and are like, hey, I'm just stacking up my money, I'm just getting started, we should all be looking into this. I mean, this is not going to last. I can tell you that one. Does the 1% beat community lenders? Community lenders are different. So for those of us who don't know, and Pete, he's tapped into one of the community lenders in Philly. Actually, these lenders saved my life. I was like knee deep in a deal on a drugged out block, I'll call it, just burnout block with a bunch of shells. And the head guy actually came in and looked at my deals. He funded them within like 3 days. Community lenders. So community lenders can be the best. They move fast. They're lending their own money. I would say they're different. The community lender is there for construction. They're there to develop the neighborhood. Typically, what a community lender is somebody who owns commercial real estate and has a lot of money. So they buy and invest and develop the commercial real estate, and then they take their excess capital and they lend it to people who develop residentially around their commercial assets. So the community aspect is they're going to carve out, hey, we just believe in this pocket. We believe in Northwest Houston, or whatever neighborhood they can come up with, right? Where they own their commercial real estate. So we only lend within these zip codes and within these boundaries. And they'll find a bunch of residential developers who are building there anyway, and they'll give them cheaper capital. So instead of getting a hard money loan that's 3% origination, so 3% up front on a 100K loan, they want $3,000 up front and then 12% annually, so 1% per month. They're going to give you that money at 1% up front, so $1,000 up front, so that's 2K savings. And then they're going to be like 6% interest, so half of the interest, or a little less than half. So, and they're going to give you longer terms, more grace, no appraisals, so they're going to reduce your fees. So they can be way better than hard money. But when you're talking about this 1%, this is more of a long-term loan. So community lenders are more about you rebuilding things around them. Therefore, it's more of a construction loan, not necessarily a long-term 30-year type of note. So this is a different thing. I don't think anything beats 1% other than like 0% down. And, there are some strategies to invest with 0% down. We talk about them a lot. There's creative financing strategies. There's down payment assistance. I have a video on the YouTube channel that just breaks down payment assistance programs and how to tap in to get them to cover 100%. But 1%, I mean, you could come to the table with $3,500, $3,500, and get the max loan, $350,000. I mean, come on, guys. I mean, you guys can really tap in there. Antonio said, Charlie, you can do it. You're in the right place. You're definitely in the right place. I mean, Charlie was, he knew, he was actually, he came to me and said, Brian, I've seen a lot of people, a lot of talking heads out here, and something here resonates about, the way that we present information here. And he tapped right in. I will give it to Charlie. He jumped right in, but he's definitely going to be a rock star. I can tell he's in a great market. He knows the market. So you guys are going to see that Arkansas is going to become a hot spot in the next 5 years. You definitely, for those who are in the mentorship program, you're definitely going to want to tap into Charlie. If you're thinking about investing out of town and grabbing some of this Arkansas money, there's a huge inflow of people. There's a lot of tourism that's building up there, and he's boots on the ground out there. So you guys definitely want to tap in. Yes, definitely the 1% is at Rocket. Is at Rocket. Are there homes to purchase that may still have equity? Absolutely. I mean, we purchase properties every day for pennies on the dollar. They're all out there. So I'm seeing them in all markets, pennies on the dollar deals. There's definitely deals that you can buy and do full BRRRR strategy type of process on. I mean, it's all there for us. It's really just knowledge based. If you can't see it, it's because you don't have the knowledge to see it yet. And that's not a knock on you. It's just a acknowledgement of that, and the fact that you need to tap into mentorship. Mentorship can be a gate opener. A lot of us will look at the cost of mentorship and say, oh, well, I don't want to pay that. But you don't understand, in this game, you pay in real estate. So even if you don't get in a mentorship, which is exponentially cheaper than any other way to learn, quite frankly, you are going to pay the School of Hard Knocks 100x that. If you get with a partner, I just talked to somebody today who's interested in joining the mentorship program, and they're in a partnership that they're like, I got to get out of this thing, and there's a lot that is going wrong with the partnership, and I'm like, man, I wish you would have gotten to me a lot sooner. I wish you would have tapped into me a bit sooner, because I could have helped you to avoid. I mean, you guys know, people ask me to go on a partnership rant almost every live we do. Ace Du said mentorship is definitely worth it. It's definitely the way. I knew it was the way. I just couldn't find the right mentor. So I ended up stuck with the School of Hard Knocks and a partner. And it was, there's pros and cons, but there's so many cons that had I had the right mentorship or like a true program, my goodness, I could have accelerated like tenfold, right? Even though I went pretty hardcore. You guys know I've done like over 300 deals in the last decade. So that's still pretty hardcore, but it could have been more. It could have been more success and an easier ride. But you live and you learn. And you just have to stay tapped in. You said maybe connection with contractors as well. I'm not sure what the question was, but if it's about the mentorship, yeah. If you're in a market that I'm investing in, we definitely connect you. We show you how to build relationships with contractors, build your own construction teams, become your own GC, all of that fun stuff. Carol said, good night, guys. Welcome to the party. We're definitely going to keep flowing with this thing. What about Puerto Rico's market? Are there different rules? There's definitely, every market is unique. Every market is essentially an independent market with its own rules, with its own market momentum, sales prices, customs, we'll call it. So there are definitely national real estate rules, but different things are customary depending on where you're at. Like I was just talking to one of our mentees, he's in the Texas market, and there it's customary for the buyer to pay all closing costs. Whereas in LA, it's customary for the seller to pay the closing costs, whereas in Philly, it's split. Whereas in Philly, you don't need a closing attorney. In Delaware, you do need a closing attorney. In LA, you do need a closing attorney. In New York, you do need a closing attorney. So it depends on where you're at, kind of what the norms are. But there's kind of both. But there's always micro rules. Also, when you get into things like auctions and tax liens and tax sales and kind of sheriff sales, all that stuff, there's different micro rules depending on what state you're in, what municipality you're in. So you just have to stay tapped in. Linked Up said, mentorship is someone who has the experience. Definitely. Not only that, though. So that's what I thought. Mentorship is somebody who has the experience. And I've had great mentors. I don't knock any of my mentors, and I wouldn't be here without any of my mentors. But a mentor is not only someone who has experience. A mentor is a great mentor, we'll call it, or a really good mentor is someone who has the experience, but also has the ability to carve out the time and has a dedicated program that can show you step by step how they got to where they are. Because there's a lot of people who could stand in and say, I'll mentor you. But if they don't have a dedicated program to show you step by step the journey, you'll never get there. They can't give you that amount of game over a cup of coffee or a lunch once or twice a year. It doesn't work that way. And a lot of people who haven't taken the time to really document the journey, break down the steps and show you step by step, they miss steps. Even when they're trying to help you, they miss information, they miss steps. And you look at them, you're like, whoa, how do I get this? How do I get that? And they don't have enough time dedicated to really teach you that game and get you to that level. So a great mentor, what I've learned over the course of time and having done mentorship, is like, wow, the availability that I have to you guys, my mentees, the people who are tapped into the one-on-one VIP mentorship program, there's no comparison between how much time I spend with you guys versus how much time my mentors spent with me. Like it's 1,000x, 10,000x. Like there's literally no comparison. And that's why some of you can tap into mentorship and start getting massive results right away, because the time is there, the dedication is there, the focus is there. So even if you guys are seeking mentorship within your inner circles, you have to understand that like there has to be a time dedication. There has to be some type of program or way for you to truly tap in and take every micro step, because we're all looking at the finished product of our mentors, not really understanding all the steps that they went through. So if there's not a way for those steps to be broken down, you will never get there. You're just not going to get there. You're still going to end up having to dive into the School of Hard Knocks, and it's going to be a painful experience. Murphy Blue said, how much is the mentorship classes, the mentorship program? You just have to tap in however you got here, text, email, reach out and, DM me. I will tell you guys the cost has been going up on the mentorship because there's been so much demand. So many of you have been tapping in that, I don't have the capacity to work with everyone anymore, unfortunately. It kind of saddens me because I love working with you guys and helping you to get to the next level. But if you're interested, definitely tap in, sooner rather than later, because, I am running out of capacity. I can only work with so many of you at a time. I do want to help all of you. I want to help every subscriber, every person who taps into a live, every person who's interested and who opts into the funnel and reads the cash flow playbook. But just make sure you guys reach out and tap in before the cost goes up. Just like these 1% mortgages, it's like I can keep the cost at certain levels to get people in, but then it's like sometimes those things, we get full and those things have to go. I'm in NYC, so 350K wouldn't go far here. I'm wondering if Rocket would allow multiple borrowers to combine their loans. That's a good question, but I would say just invest out of town. Go up to Connecticut, go up to Hartford, get something up there, go upstate, go up to places like Buffalo, some of these cheaper markets, and just you can get for 350, you can get a 6-7 unit in Buffalo. I don't know if they'll lend on that necessarily, but you could definitely get a 4 unit for probably a quarter up there. Go get a big quad, 3,000 square feet, just cash flow the mess out of it, right? Like just go where the money is. Jonathan said Brian Grimes is like her dad. Like it is what it is, guys. It's the truth, man. This is all the truth about real estate, and this is here to help you guys to get to the next level. So definitely tap in. Jonathan recently tapped in. We're working with him on some ground up stuff, and we connected him right with the resources from. It was like day 1, day 2. We got him tapped into the resources. Everything's in motion, and a lot of money could be made there. So I'm interested to see how this thing develops, and I'm going to be a part of it. I know this is off topic, but what state do you start your LLC? Does that matter a lot? I heard Wyoming is the best. Yeah, it's an interesting question. I mean, it does matter because you want to look at things like annual filing fees, renewal fees, and some of the fees associated with maintaining your LLC. They are different state by state. If you're unfortunate enough to ever be in a lawsuit, you will learn that some states are better for corporate lawsuits than others because they have different types of court systems. So there's different regulations on how lawsuits and disputes are handled depending on the state that has jurisdiction over the LLC. So if you're in a partnership dispute or anything like that, there's going to be differences there and wrinkles that you'll learn about. There have been privacy laws. So in places like Wyoming, Delaware, historically, you could just file your LLC there and there was great privacy protection because you didn't even have to file like your name on the formation documents. So it's just like nobody knows Charlie owns this thing. They just see it's 123 Main Street LLC and nobody knows who owns it. But there's new LLC privacy acts that are coming out that are requiring people to backwards facing go and disclose that they own, one LLC or another. So now that they're in that type of a situation, which that's all going to happen in 2024, like you have to disclose for most of these LLCs. And then by 2025, everybody has to disclose, even if you opened it in Delaware or Wyoming, some of these states that have great privacy laws. So you're kind of losing some of that privacy benefit, in my opinion. But you're still looking for low cost, good litigation protection, some of those things. So that's what you're thinking about. Farrell said, this is the most informative, all-encompassing program out there. B got the knowledge. And that's my man, JR. Look, it is what it is. I mean, you guys can go tap into other programs. I mean, look, some of these guys are great marketers. They can convince you guys of almost anything, and they'll drive around in the Lamborghini or hang out on the yacht for you. I'm not going to do that because I'm just here for the real. I'm here to really help the people who need the help and stay grassroots with it. But this is the true knowledge. This is multiple strategies, 5, 6 different core strategies that will all be able to make you money and allow you to pivot and become a master investor and show you the cost of construction and all of the things that, quite frankly, a lot of these programs are missing because these people have never built houses before and they don't know what they're doing. And they don't invest out of town. and they don't really care about helping people. They're just trying to pad their pockets and get on, get more Lamborghinis and fly more private jets. If that stuff impresses you, go do it. God bless you. If you're really trying to get out of the rat race, tap in and don't second guess it. Stop looking at the market thinking you're going to perfectly time this thing. Just get in and get after the real estate, because like I said, I know guys who lost 50 to 100,000 when they were just getting started. They recovered all of it. Now they're up $500,000 and they're knocking it out. They got big portfolios. They're cash flowing 15, 20,000 a month. I mean, you guys can definitely do this. Would Rocket allow investors to refinance out at 1%? Good question. You have to tap into them. Look, this stuff just came out a week ago. So even a lot of these questions and information is not publicly available yet. You really should call, tap in, and see what's available. Pete said resource and connection with the mentorship. Yeah, Pete, we got him tapped in. We tapped him into the resources, the lenders, pretty much all the connections that you can imagine ever wanting to get into real estate. And when you're getting into real estate, it's not necessarily about you, it's about your team. It's about the resources. It's about the contractors, the architects, the engineers, the permit expediters. All of these different people are what are necessary for you to win and for you to be like at that big time level in real estate. So that was a lot. Let's get into some more. Guys, keep the questions coming. I just wanted to stop to answer all of those questions. You guys know I like to check in with you and make sure you guys are getting your questions answered. This is Yahoo Finance. Dave Ramsey. A lot of you guys know Dave Ramsey. I thought this was funny because Dave Ramsey. One thing I will say about Dave Ramsey is he's free. He's a free thinker. Like, he thinks his own way. He's a contrarian. What I've learned over the course of time, managing money for millionaires, working on kind of like that Wall Street type of stuff in New York, working in financial planning, is the contrarian thinkers, the people who watch the news to see what the masses are being fed, and then free think and say, look, that's garbage. That's what they're feeding the sheep. Here's what's really going on. Here's the contrarian thought. Here's what I'm seeing. Those are the people who actually tend to be more correct on the market. Because if the mass media is feeding you a message, you should sit on the sideline. The market's going to crash. Everything's going to go down 30%. It's usually a lie. That's usually because big money is buying everything and they want you to sit on the sideline. So they're going to fund mass media, which is typically owned by just a few people. So they'll fund it. Hey, write some articles about this. Here's some money. Get that promo. And then they'll take their capital and they'll go buy everything while you're sitting on the sideline. Dave Ramsey, I don't agree with everything that he says, but he's pretty much been predicting that the market is not going to crash. This is kind of his article. They say the overall housing shortage continues to keep real estate demand up across the country. So some of the things that are keeping demand up are, meanwhile, like the number of prime home buyers in 2008. A lot of us talk about when the market crashed in 2008, and we're trying to see if this is another 2008. In 2008, you had Gen Xers. There were about 55 million people, and they were like the prime home buyers. Right now, you have 66 million prime home buyers, the millennials. That is keeping demand high. So even as rates are going up and a lot of things are happening, we have housing shortages because people are not putting their properties on the market. We have a 6.5 million home shortage for single family homes right now. We have 7.3 million, a 7.3 million unit shortage for affordable housing right now. And that is going to keep the market propped up. So what Dave Ramsey is saying, as those factors converge in the pandemic, a lot of panic has set in. Everyone's going, oh, it's all going to go away. It's going to be another 2008. The market's going to crash. And he kept saying, no, it's not. It's not going to go bust. I think we can just stop and say, I told you so now. And that's coming from Ramsey, who at least he's on the market. He's scanning this stuff every day. He definitely has a new way of thinking, but he's just flat out saying, look, I told you so. Like, the market ain't going to collapse. I've been saying it for a long time as well. The market's not collapsing. There's so much pent up demand. There's so many sellers who aren't going to sell because they can't buy back in at good interest rates right now. So
sitting and waiting out the market, what's going to happen to the overwhelming majority of you, and we're going to get into mortgage rates next because a lot of us has that question. What's going to happen to a lot of you is you're going to sit there and wait, and mortgage rates are going to go back down, which we'll talk about next. And prices, when rates go down, you guys know the average person can afford more house. So the prices are going to go higher. And you're going to have missed out on the opportunity. The real opportunity right now, and I want to be very clear about this, the real opportunity is to buy relatively soon, to buy now before rates really start to go back down. And then as rates go back down, you can refinance and unlock cash flow. That's what the smart players are doing. They're going to buy the best deals now, buy low to the ground. You know, you could still buy some properties, even in a place like Philly, for 70, 80 grand, and then put 40 grand into them, renovate them, rent them out, refinance your money out, do a bird deal, and then sit on that deal for 2 years. You might be cash flowing 300 a month. When rates go back down, you refinance. Now you're cash flowing 500, 600 a month off of the refi. It happens all the time. Heck, I did refinances on my first deal because interest rates ticked lower. I got a call from my mortgage broker. He said, look, I got a streamlined refinance form. We can refinance this thing, no appraisal, no nothing. And you're going to get an extra $150 a month in cash flow. I was like, where do I sign? Let's do it. So a lot of people are going to start making that call. But let's talk about interest rates. And guys, like, comment, subscribe. Leave the comment that says I subscribe. Share this video with somebody who you think will get value. Keep your questions coming. Drop your questions, comments in the chat section. So a lot of you have questions about mortgage rates. Here are some of the predictions for where rates are headed. So the Freddie Mac chief economist, let me blow this up a little bit for us so we can see even better. The Freddie Mac chief economist, Sam, I'm not Cater, the rate of inflation decelerating rate should gently decline over the course of 2023. We've got Fannie Mae 30-year fixed rate mortgage will average 6.4% for Q2 of 2023. So that would even be down from where it's at right now. It's at about 6.7. The National Association of Realtors forecast that mortgage rates will drop with the 30-year fixed mortgage rate progressively falling to 6% this year and to 5.6% in 2024. That would be rates going back down. And once you get in the fives, you can cash flow very strong in most markets, I would argue. Bank of America head of retail lending, Matt Vernon, Bank of America Global Research expects mortgage rates to fall to 5.25% by the end of the year, 5.25. That would be over a point lower. And one thing I want to touch on, and I'll get into some more of these, rates went up really fast, right? Like in a year, they doubled. So typically there's like a philosophy in the stock market, like when things go up really fast, they can come down really fast. So even though historically rates have moved slow on the upward trajectory and downward, what you should anticipate is what goes up fast can come down pretty fast. So don't think that rates are just, they're up and they're going to be stuck there and it's impossible to get them low. As fast as they went up, they could come down equally fast. In the next 6 months, they could come down a point easily. And that's how you can miss it, because you're sitting on the sidelines and this thing's going to move quickly. Like in a month, oh, rates are down, people are buying, and you're like, whoa, I don't even know how to do my market research yet. I don't even know what I should be buying yet. I'm not tapped into mentorship yet. Like you're going to miss the boat there. Let's look at a couple more of these. We got our forecast is for the 30-year mortgage rate to be closer to about 5.5% by the end of this year. I'm telling you, they're at 6.7 right now, and they're expecting 5.5. And then they expect it to drop a little lower next year. So you have a lot of people, and these are your top economists across the country, some of the top lending groups. They're projecting, rates are going to go down. We're going to get a rate decision this Wednesday. And the anticipation, about 80% of the analysts are projecting that the Fed will actually pause rate hikes. So they're going to do a 0% decision on Wednesday, which would be the first pause, I believe, in the last almost year, maybe longer. I want to say 13 months, but that might be too aggressive. But this will be the first halt. they've already reduced the amount of rate hikes from 0.75%, like 75 basis points, to 50 basis points to a quarter. Now they're looking at their first zero. The thought process is they want to scan the market, see what's going on, see if now's a good time to completely pause rate hikes. And if they don't, then they can, make another decision in July and maybe increase in July. But even if they increase in July, the thought process is in August, September, they will completely halt. So if not now, by then they will completely halt, and then they will start to pull back rates slightly. So, guys, rates are more than likely going down. Keep your questions coming in the comment section, in the chat section. We have a few more things I want to cover. So foreclosures are spiking. So a lot of us who are, into some of those creative financing strategies, and we're looking for people who are in foreclosure, pre-foreclosure. How bad of an omen is this for the 2023 housing market? So about 1 in every 4,000 homes had a foreclosure filing in May. According to a recent report from the real estate data firm Adam, foreclosure filings shot up 7% from April and were up 14% year over year. So foreclosures are increasing. A lot of people just can't afford the house they're in, people are saying, and I want to find where the foreclosures are highest. So where are foreclosure rates the highest? So this would be the area for opportunity. If you're looking at any of these markets, here's where you should be thinking about investing or going after people who are in foreclosure, pre-foreclosure. Illinois, Maryland. Maryland's a huge market, and Baltimore, is definitely included in that. New Jersey. These 3 markets had the highest foreclosure rates in the nation. In Illinois, which, Chicago's definitely mixed in there, 1 in every 2,144 homes received a foreclosure filing letter. Florida and Ohio rounded out the top 5. So these are your top markets there. Homeowners in Florida were the most vulnerable to losing their homes. Lakeland had the most foreclosure notices of any metro in the country, with at least 200,000 residents. About 1 in every 1,361 homes received a foreclosure filing in Lakeland. So these are some of the markets you want to look in, but foreclosures are up. Foreclosures on more than 4,000 properties were completed. So people got foreclosed on. 4,000 properties foreclosed on. That's 4,000 opportunities for those of us who know about creative financing. If people are getting foreclosed on, many of these people don't know that subject to is an option for them. They don't know. Nobody got to them in time, or they were too stubborn. They don't know lease purchase options, all of these different strategies, these creative strategies that you can approach people with who are in various degrees of foreclosure. They just don't know. So 4,000 completed. Not saying that that's the highest I've ever heard of, but that's a 38% jump from April and a 41% increase from the same time last year. So foreclosures are definitely, on the uptick there. So it's definitely something to, keep on your mind. Let me see. We got a couple of questions in. I'm in Lafayette, the Dirty South. Is there anything you can say about the market here? Louisiana, like, one thing I can say is we know the insurance premiums have been going crazy. So I've been helping a lot of people in that market to invest out of town. And I think you're not necessarily in a priced out market, but the market is hot. Prices have continued to go up, which you've seen. And some of your better opportunities are investing out of town, taking your money where it goes further, especially because of the insurance premiums. They've gone up maybe 200, 300% in some instances, like overnight. And when your insurance premiums are going up like that, it's eating into your cash flow. So you can go out and get a 30-year fixed mortgage on a property, but if the insurance keeps going up, the taxes keep going through the roof, or the rents decline, you're going to lose money. So you want to be in some of the big cities where rents are increasing or projected to increase, where there's constantly an influx of people moving in, which is why I like things like sister cities, what I call them, which would, Philadelphia would be a sister city of New York. So New York, the bigger city, more expensive, people get priced out, they move to Philly. Places like Baltimore would be the sister city to Washington, D.C. So as people get priced out of D.C., they shift over to Baltimore, however close they can get to the city so they can still get to their jobs in D.C., but then they can live more affordably. I would say the South, with the the weather changes and the hurricanes and kind of all the things that are hitting, the insurance is eating into your cash flow, to the tune of an extra $300-400 a month in most of these instances, and that's enough to, with higher interest rates, just wipe out cash flow in some of these markets. So you really should be looking for ways to invest out of town, strategies, techniques. How do I get started with that? These are all things that we teach you in the 100 Keys Masterclass, because out of the 300 properties that I've built, I've done essentially, I want to say essentially all of them out of town to a degree, maybe one or two in town. I would say most, over 98%, 99% of this stuff out of town, using the same systems that I give you in our mentorship program and that I coach you guys through. So investing out of town is the way to go. The last couple that I helped in Louisiana, they actually invested out of town, got a duplex cash flowing in Ohio. I believe it was Cleveland or Columbus. I have to double check, but they got it for $80K, cash flowing $600-700 a month, and it was way better than anything we saw in their home market. So that's my philosophy. If your home market's not giving you the opportunities, then pick up your money and take it where it goes further. It's really that simple. Let's not overcomplicate these things for ourselves. A lot of us do, or we just beat our head against the wall, or we think we'll wait out, the South. We'll wait out Louisiana. You're not going to wait it out. The insurance company don't care, because if the hurricanes don't stop hitting, the premiums are going to keep going up. They're not even done going up now. So some of these markets are getting prohibitively expensive. It's the same reason that if for my New Yorkers out there, like a lot of you wouldn't invest in North Jersey, in Bergen County, or some of these areas, because the taxes are too high. Or why would you go in Newark, where the taxes are 12 grand a year on a property where you can barely get any rent, and it's kind of in a rundown neighborhood? Like, the taxes have to come down in order for it to make sense. Some of these taxes or insurance premiums are like a second mortgage. So that's what I would say about the market, is just keep your eye on all markets. You have to, as an investor, compare your market to other markets. You have to compare your market to the other best markets in the country. And if your market doesn't stack up, then go. You know the answer. I got to get out of here. Now, you might not know the steps to invest out of town. That's what mentorship is for, so that you don't make mistakes. Because I will say, as you go to invest out of town, you need mentorship more. You need to work with somebody who's done that before, because there are intricacies and wrinkles that you need to be aware of, because if not, you're going to cost yourself at least probably 50K in mistakes. Like, it's gonna be ugly. Keep the questions coming, guys. But that was a really good question. When refinancing out of an investment property with rates being relatively high, how long does it typically take to refi again once rates go down? I mean, you just want to make sure. Some of these lenders will try to do things because they know we're going to refinance. So you have to watch some of these lenders. They'll try to put in things into the contract that say you can't refinance within a year, or there's some type of penalty, or you don't want to be dealing with a bunch of lenders like that. You pretty much want the freedom. If 6 months from now rates drop 2%, which they could, like I said, they went up fast, they could go down fast. The indicator is how quickly they went up. Just like people say, money comes fast, it goes fast. Everything that comes fast goes fast. So they could fall fast. You don't want to be stuck in that situation. You also don't necessarily want to be tapping into 30-year fixed mortgages necessarily right now. You're better off with a 5-1 ARM, with like a 5-year lock-in with an annual renewable after that. You want to be planning for the lowest possible cost. The reason is, if you do a 5-1 ARM, let me see if I can pull up what that looks like so you guys can see it. Yeah. Yeah, I'll pull it up right here. If you do a 5-1, you can kind of see the breakdown here. The 30-year, I'll blow this up a little bit and slide this over. The 30-year is, let's say it's at 7%. The 15 is lower, but the 5-1, which is still going to be kind of on a 30-year AM, it's only like 5.96. So you're saving like a point in interest by going with a shorter term, like a 5-1. A lot of people have viewed this as risky historically, but that's because we were in a lower for longer interest rate environment. We weren't in a rising rate environment. over the last decade. So a lot of the knowledge you guys have been taught, oh, avoid these, just go get the 30-year. That's the safest play. That's the safest play when rates are at a historic low. When they're not at a historic low, but like we just reviewed, they're projected to go down, the safest play is to put yourself in one of these short-term loans, keep your rate low, cash flow, and then refinance out later and lock in at the lower rate. So that's kind of the strategy. But there's a YouTube video on the channel. If you guys are subscribers and tap into the YouTube channel, there's a video on there about my mortgage rate buy down strategy. And it breaks down a lot of this and the best type of mortgage to get into. So that's a good question there. But I would say it doesn't take long to do a refi into a lower cost product at all. It doesn't take long at all. But it's just something you want to be, more or less aware of there. So let's tap into this. Guys, keep the questions coming. Like, comment, subscribe. Leave the comment that says I subscribe. Share this video with somebody who will get value. And let's keep flowing. So affordability remains steady throughout the market. Prices haven't really changed all that much this year. Prices have kind of been flat, which was where I thought they would be, more or less. I thought they would be pretty much flat for the year. They haven't gone up, but they certainly haven't tanked in most markets. Maybe they've dropped 10% in some of the super overpriced markets. But in some markets, they've actually gone up. Most they've remained relatively flat. Overall affordability changed little in the first quarter of the year for first-time home buyers across the nation as a whole. Homes were listed at 5.5 times first-time home buyer income. We've talked about this, guys, in terms of the multiple of income that is within the affordability range. Anything within that 5 to 6 range means the average American can afford the housing. Once you get beyond that, it becomes unaffordable for the average American. It means your real estate market is in a bubble. In the nation's largest metros, they were priced 5.6 times typical first-time home buyer income, which is up from 5.5. So it's slightly up, but not really, right? Metro areas in California have historically been the least affordable in the nation, which is why if you're in California, you better be learning how to invest out of town, unless you just have tons of money. This most recent quarter has some familiar faces. Among the costliest, Los Angeles, where homes were listed at 11x the typical first-time home buyer income. San Diego, 9.6. San Jose, 8.7. New York City's in there. Miami's in there at 8.6, above New York, which is 7.3. New York's actually been coming down because, a lot of people have been moving out of New York for various reasons. But they said this is the first time in the analysis that New York metro area was among the 5 least affordable locations. So there's still been more on the West Coast in terms of a lack of affordability, but New York's kind of in the mix. As for where first-time home buyer money can go the furthest, this is where our eyes start to perk up. Just 2 metros had homes listed at less than 3x the typical first-time home buyer income. So they're way below that 5 to 6x range, which is where I would say things cap out. This is the second quarter in a row that Pittsburgh, not Philly, because Philly's a hot market, but Pittsburgh has been that sleeper market that a lot of people are tapping into with out-of-town investing. Heck, I may pick up some stuff in Pittsburgh as well. It's a good, strong market. Homes were listed at 2.5 times first-time home buyer income. Cleveland, we all know about, 2.9, had the affordable designation. Other close contenders include Detroit, which Detroit property values have actually been declining in Detroit, which tells me, one, you don't see a lot of people buying in Detroit, but Detroit just has not appreciated. So even the people who tried to buy in because it's cheap, it just hasn't gotten, caught in the developer's eyes, in my opinion. So you have Detroit, Buffalo, New York. I know a ton of people that are crushing Buffalo, New York. If you're a New Yorker, you should be looking at Buffalo. If you're just getting started, you're trying to pick up some big buildings. There are people picking up 6-7 unit buildings for $300,000, put some renovations in them, even less sometimes. Maybe pick them up for $180 if they need a bunch of work. Put some work into them, elbow grease, rent them out, and the values will increase. And then you have St. Louis. St. Louis has a great stock of multifamily housing. Baltimore, they're both at 3.6. So these are some good markets that you guys can invest in as first-time home buyers. So Guys, I hope this information really helped. We're jumping in on about an hour. So if there are no more questions out there, I'll hang on for maybe a few minutes. If there's no more questions out there, I'll sign off. If you guys have questions, definitely drop them in the comment section, drop them in the chat. Hopefully this market update helped. But what you should really take from this market update is the market's in flux. There's new opportunities coming aboard. Interest rate increases by the Fed. They're going to about face. People are projecting that rates could be as low as 5.25% by the end of this year. Right now we're at almost 7%. So that would be a 1.5% drop. That's a lot, guys. That's a lot of a drop. But what goes up fast will come down fast. So don't get stuck. Don't get rocked to sleep by this market. Because if you sit on the sidelines, when rates go down, Antonio said, don't forget the deal analyst spreadsheet. I will send it to you. When rates go back down, you're going to miss the boat, and prices are going to go up quickly because they've been stagnant. They've been held back. When they go up and rates go down, you're going to miss out. So don't sit on the sidelines. Tap into mentorship. If you don't know where to go, tap into the 100 Keys Masterclass program. Tap into our mentorship program. If you want to learn more about it, the costs that are there, reach out. Just reach out. Reach out. However you got here, email, text, DM me on all the social media channels. I left all the descriptions to the things that we talked about. They're all in the description of this video. So you can tap into any of these links, read the information for yourself. Charlie just called Rocket Mortgage. He said there's a 620 is the lowest credit score that they accept. So, and that's pretty low. I know some of us who, tapped into mentorship or who've been thinking about it are working with credit scores where we're just trying to get them back up. 620, you can still get in the game. Has to be a primary residence, but like we know there's wrinkles around that. Primary residence could be multi, where you live in one unit and rent out the others. Can't be under LLC, has to be in your name. And we're hoping he gets accepted. And he appreciated the live stream. Some think stagflation is coming, which could really shoot up prices. Absolutely. I'm one of those people that thinks that's coming. How do we know when to slow down on acquisitions? I'm moving ahead scared, but moving ahead. Look, if you're not a little bit concerned, you don't have a pulse. You should check yourself. You should go to a doctor and get a physical. You should be always a little bit concerned when moving through real estate. But the more education you have and the longer you survive the game, the less afraid you are. Because you'll have survived so much and seen so much, you'll just be like, I know I'm on the right side of it. I know what's going on. You shouldn't slow down your acquisitions. How I see real estate is, real estate developers are like sharks. Sharks don't stop swimming. If they stop swimming, they drown, right? So even when they're asleep, they're still swimming. As a developer, you're a shark. So you should always be in acquisitions. The day you shut down your acquisitions is essentially the day you die as a real estate developer. You have no deals to work on. You lose your crews. The lenders forget about you. And you're just a dinosaur at that point. So you should always be doing your acquisitions. You should never really feel sped up and or slowed down. If there's any time to take your foot off the gas, it's when you've acquired whatever that dream number is. Is that number $20,000 a month in cash flow, $10,000 a month in cash flow, $30,000 a month in cash flow? When you hit that goal, you may want to ease off the gas a bit. Don't stop your acquisitions, but you may choose different types of deals. But you always want to move at a comfortable pace. Never move too fast. Also, never move too slow. Just continue to pivot. Continue to scan the market. Stay tapped into what's going on. Diversify your book of business. So you may fill up on a certain city. You want to go to another city or another township and continue to spread your money around. That's part of playing that monopoly game. But do not stop your acquisitions. That's an easy recipe for stopping the money. So just keep it flowing. Repeat after me. There's always opportunity in real estate. There's always opportunity. The market's always changing. And as it's changing, you want to be tapped into the opportunity that is available to you. What's moving too slow? Sitting on the sidelines, trying to wait out the market. Because why would you wait out? If your market's overpriced, just go to a market that's not overpriced. I don't think there's ever been a time, or is going to be a time in America where every real estate market is priced out and there's no opportunity anywhere, unless we just let the big banks take over and America becomes a full renters nation. In which case, you better hope you've been listening to me and that you got into real estate and bought some properties, regardless of what price they are, right? So even in that worst case scenario, like I said, take it all to the worst case. In the worst case, every market in America is priced out because you sat on the sidelines too long. The big banks and hedge funds came and bought it all up, drove all the prices up, and now all you can do is rent. You should have listened to me and bought real estate, even at what you believe or perceive to be an expensive price today. So moving too slow is not really moving at all. Doing less than one deal per year is probably moving too slow. You guys should be targeting 2 deals per year. Your first year, if you're just getting started, do a deal. Figure it out, see what you like. After that, you should be doing at least 2 deals a year. And you should be figuring out how to do that. And it's not a matter of how much capital you have. It's a matter of knowledge. Moving too slow is not tapping into mentorship because you think you're smart enough to figure it out, something that somebody else has already figured out, and not accelerating. So that's moving too slow. There's multiple ways to move too slow and multiple causes of moving too slow. But the end result is you're not going to get enough deals, and somebody's going to eat your lunch because somebody's always working. Somebody's always getting the knowledge. Somebody's always putting out offers and taking shots and taking chances, and they're going to get those deals while you're sitting on the sideline. So I think anytime you look at yourself and you find, like Roland said, like, I'm moving ahead scared. At whatever point he allows fear, and I'm not saying Roland will, but if he allows fear to sideline him, now he's moving too slow. That's the definition, because now the fear has taken over. Fear traps you. Knowledge frees you. So when you're focused on fear, you're trapped. You're just focused on all the negatives, and you're afraid to then take it to the furthest end of the negative and say, hey, even if this happened, I'm still going to win long term. But if you say stuck in fear, you're going to move too slow because you're going to be of that philosophy, that mentality, that vibration of energy. You need to be in knowledge. So whenever you feel that, you need to get more knowledge is the answer, so that you feel less fear and more confidence. You replace fear with knowledge, with knowing. Just like you roll out of the bed in the morning, you know the floor is going to be there. You don't have to look down and make sure the floor is there before you roll out of bed. You just roll out, boom, feet on the ground. I'm ready for the day. Ace Do said 20K a month in cash flow. That's the goal. So you keep sprinting until you hit your goal. Then you can take a breather. You take a deep breath and you sprint some more. You come up with a bigger goal. You climb high so you can see further, and then you climb higher. I think I was talking to Charlie. And Leon said, hey, Charlie, Leon is in Hot Springs. Exactly. You guys, Leon, we were talking for a while about how Hot Springs, Arkansas is blowing up. And Charlie's out in that market too. You guys should definitely connect. And I believe, Leon, you have access to contractors and things like that. That's another benefit of being in a mentorship program, because we're working with people from all over the country. You guys can tap into other people who are investing in your market, and you guys can make money together and share resources and knowledge and systems. So definitely, Leon, you guys should connect. You guys, I believe you're both in the Facebook group. If not, you guys should both tap into the Facebook group and connect. Or if there's somewhere to message each other privately or something, you guys should definitely connect. Or I'll connect you too if you want to be connected. But yeah, that's just part of it, guys. It's just staying tapped in. I was talking to Charlie about that. You just have to have knowledge of this game. You have to have knowledge of this game. You have to study the market and just, kind of go for it. So we all start somewhere. We all got to have goals. But what I was talking to Charlie about in particular was my goal. He said, well, what was your goal when you got started? So my goal was to get 10 properties, 1 house a year for 10 years. And, then I was going to have enough, maybe $5-6 grand, and I could step out of the 9-to-5 and live off the real estate, off the cash flow. That was my goal when I got started. That was my 10-year plan. It was 10 properties. In 10 years, I did over 300 deals. So what kind of goal was that? Imagine if I had stuck to that goal of 10 properties. I could probably be like some of the other talking head gurus out here, right? Because they've only done, a lot of these guys have barely done 10 deals. They haven't done 300. But having done 300, I look back and say, well, I don't really buy into even my own goals. I know some of my goals are just there temporarily until I get close to them, until I get close and I see how achievable they are. And then I immediately I double the goal. I double it, I'll triple it. So a lot of you guys should think that way, is as soon as you get close, you should double or triple your goal. Tia say, yeah, I'm gonna have my training wheels on for a while. There's nothing wrong with training wheels as long as you're pedaling. As long as you're pedaling and you're pointed in the right direction, even with the training wheels on, you're still going to get to the destination. And eventually you're going to get enough confidence to knock off, the training wheel and just keep flowing. So guys, I hope this helps. I really hope this helps. Definitely stay locked in, stay tapped in. If you're not in the mentorship program, definitely tap in if you're looking to get into this game, and you should be. Do not sit on the sidelines. Do not wait. The market is not going to collapse or crash. Not the real estate market. Stock market might, but not the real estate market. Sorry, it's going up. And if you don't get in, you're going to get left behind. And that's the warning. I don't want to say I told you so to anybody. I want everybody in and everybody, eating and even failing forward if you have to fail forward, if that's what's meant for you and part of the plan. But do not sit there and watch us all win, because we will win without you. We will win without you guys, regardless. You can sit there, but you're not going to be the one that said I told you so. Trust me. When doing deals out of state, would I have to travel to other states for the deals because I'm literally check to check? No, you wouldn't. That's the crazy part about doing deals out of state. How I explain it is, this is how I've been explaining it lately. Think about a plane. So you get on a plane and there's all these passengers. And to passengers, they're like, well, who's the big dog with the plane? The big dog is the captain, right? The captain of the ship, the captain of the plane. They're driving it. They got all the talent. They went to flight school. And you're like, they're controlling everything from your purview. But the reality is, and a lot of us are the captain. So we think in real estate, we're going to fly the plane of real estate. We're going to stand in the house with a hammer and do the Property Brothers thing. And we're going to make our money and invest our time into the deal. We're going to learn everything. We're going to know everything. We're going to be able to pull all the levers ourselves. And we're Mr. Everything. We want to be that position. And the reality is that person, that captain, even though they're flying a plane and they know all this, they can only fly one plane at a time, from one destination to another at a time. Now, think about the person who owns the flight company, who owns American Airlines. You know who's really important to them? The guy sitting behind the computer screen who's air traffic control. Because the guy sitting behind the computer screen, air traffic control, is managing 100 planes at once. They're managing the whole fleet. So they're sitting there from a computer screen, all their monitors, and saying, hey, to the captains, hey, I need you to go 30 degrees left. You're in an opposing airway. I'm going to need you to do a couple figure eights. We're going to have to delay you because we have some other people coming in. We're going to have to delay this flight a little bit. They're given the directive. And if you want to make big money, just like the owner of the airline does, you better become air traffic control. That's actually the major focus of the business owner. It's air traffic control. How many planes can I get from point A to point B in a day? Not getting one there. The owner of the airline is not sitting in the freaking plane flying it. They're managing air traffic control. And they will hire pilots. The pilot is actually the contractor, the foreman. That's your GC or your subs. Those are the pilots that you want to put in the planes, which is the real estate, so that they can drive that from point A to point B, which is from starting construction to finish. That's them. You don't need to become them to make money. You need to become air traffic control. Air traffic control by nature, do they get on the plane and fly anywhere? No. Their value is in being able to see holistically the big picture. This is the developer, to see the lender, the architect, the engineer, the permit expediter, everything that's going on, the timelines, the supply chains, the market. What's the market doing? What are interest rates doing? They're looking at all of this as a developer and then making decisions. But that's why they get paid the big bucks, because they can do it times 100 from home base. So you need to learn the systems and technology that the real estate version of the air traffic control has. That's in the 100 Keys Masterclass. That's the systems, the technology, the people and personnel, and how to manage them. But that's all a remote process. That's the best way I can explain it to you guys. So, no, in fact, you going to other cities is of no value to a degree. You having resources and teams and systems that tap you into other cities is of high value. But what are you going to do? You have to think about it. What are you going to do standing in a house, watching over a guy who learned how to build houses since he was 6 years old from his uncle, and he's 42 now? What are you going to tell him? Like, what is your value there? He doesn't need you there. He needs you on the phone with the lender. He needs you on the phone with the architect. He needs you on the phone with the engineer. He needs you on the phone with the city inspector, coordinating. Like, that's where he needs you. He needs you in the positions he's not in so that you can have a successful operation. He doesn't need you watching over his shoulder. You don't even know anything. So that's kind of, how to think about it. Murphy said, I appreciate it. I hope this gets through, because sometimes it's hard to explain to, and it's not about you, Murphy. Like, I'm not trying to like knock the question. I think it's a great question, but this is the way that you guys have to understand this, all of us, because a lot of us have that question. This is how you have to understand it, your true value and how you can unlock yourself. I mean, I built hundreds of properties in my underwear at the kitchen table, chilling with my kids. Like, that's the power of the knowledge that you need to tap into. Tia said, jump in the net will appear. Facts. Property management, another system to tap into. Use property management first. Scale up to a certain level, then fire the property manager, hire virtual assistants, manage it in-house. A lot of people do the reverse and they lose. I get the mentorship. Do I get, so if I join the mentorship program, you get access to the mastermind calls, the support, so the text and email support with me and my team, and the content forever. I actually just added a new section to the 100 Keys Masterclass last week. All of my VIP people who joined the mentorship program 2 years, you all get access to every new thing that I create, and you guys know that. That's part of this. So you're on the journey for life. There's only one way out of this thing, and it's success. You're in until you're successful, period. So when you join the mentorship, I got your back until you don't need me. It's the Mother Goose strategy. I'm going to coach you there, hold your hand through the deals, we'll walk through the park until you push me away and you're ready to fly on your own. And the goal is to make you that person, by the way. It's not for you to be dependent on me indefinitely. It's to make you a truly free-thinking, independent developer who can see the market, react, make money in multiple markets, invest in town, out of town. Is to essentially print a copy of my knowledge and give it to you so that you can go make money, feed your family, go educate your family. This is the way out. I'm here to pull you out of the matrix. I'm here to pull you out of the rat race. It does nothing for me to see you stuck in the rat race. It does nothing for our communities for you to not get this knowledge and go out and build millions of dollars worth of properties. It does nothing for any of us, quite frankly. It wouldn't be worth me doing these live calls weekly. It wouldn't be worth it. And if I didn't believe you guys can do it, I wouldn't have a mentorship program to begin with. I wouldn't waste the time. I actually believe that I could go out and try to build thousands of properties, or I could build 1,000 developers. If I build 1,000 developers, we can build 1 million properties together. There's more impact in building you guys than there is in building properties. You are more valuable than building properties. Because building your knowledge is building multiples of properties. So this is here for you guys to truly get out of the rat race. Take the freaking life raft. Unless you got a better plan, go for it. Hope it's not buying, more crypto, which is crashing right now, and it's going to continue to crash with the market. So definitely tap into either our mentorship program or find some other one-on-one mentorship program. I can tell you for a fact, the average cost of one-on-one mentorship is somewhere between $16,000 to $30,000. our program is way more affordable than you'll find out there. But if you want to go out there, do your research, bark up some trees. They got group courses out there for $8,000 where you don't even talk to anybody one-on-one. But so if you guys want to go get beat over the head. When you're ready, you'll come back. We'll be here, but we're here for life. So you do get lifetime access. Go get beat over the head. God bless you. You're not hurting my feelings. Oh, I want to talk to this. You're not going to hurt my feelings because I already know those guys. I already know what they charge. And I already know the service they provide. And they're one-dimensional. They're only going to teach you one strategy that I already know is going to get wiped out by the market. I already know. So, look, you guys just got to tap in. For those who are tapped in, they already know. So they don't, you just see the comments. They're like, yo, it's the best program. I don't even know kind of how the phrasing goes. But they're just like, look, you're going to get the knowledge. What else can you say? But some of us, I get it. We're skeptical. We would rather be skeptical of everything except for being stuck in a 9-to-5. Be skeptical of your boss and your 3% raise after working years. Be skeptical of that. Be skeptical of being stuck in a 9-to-5 for the next 30 years until you're burnt out. You don't have the energy to do real estate. Be skeptical of that strategy. Don't be skeptical of knowledge. There's nothing to be skeptical of. You're going to get knowledge that's going to free you as a thinker who can navigate real estate markets and make money. If you want, there's nothing to fear there. If you think about it this way, like on the average real estate investment, you go into that investment that you make, you could lose money because it's an investment. Every investment has a risk reward profile. So let's say you make mistakes, you don't know what you're doing, you could lose $50,000. You can't lose $50,000 by tapping into mentorship. The loss, you have to take things to the worst case scenario. The worst case scenario, which I've gotten in the mentorship programs that were like lousy before, but they're all group courses. There's no one-on-one. You get into a group course because you got sold, you were excited. You got into some group course that nobody's going to spend one-on-one time on you with. That was your first mistake because most people don't get value out of group courses. Not saying that you can't dip your toe into a group course. You can dip your toe in, and if that's all you can afford, then you get in a group course. But don't get into an $8,000 group course, right? Like that's a mistake. A couple $100, $500 or like less group course because that's what you could afford. That's fine. I'm not talking about that. I'm talking about like a $5,000 to $8,000 group course. You spend no one-on-one time with anybody because you're not going to get the result that you're looking for out of that necessarily. So even if you did that though, your max loss is the investment. Your max loss is still capped at $5,000. So you take it to the worst, or $8,000. So you take it to the worst case scenario. I'm going to lose $8,000 and maybe not get any knowledge. But some of you know you're not going to get knowledge because you looked at some of the people's content and they're standing in front of the Lamborghini and they're on a yacht and that's what they're selling you. After that fades away, you're like, whoa, there's no knowledge, but there was never any knowledge to begin with. It was just a Lamborghini and some BS. When you see actual knowledge, if you know that you're going to get knowledge, then there is no risk. There is a risk. It's you. It's not the knowledge or the person. Now it becomes you're the risk. The risk is almost scarier, which is, am I full of it? Am I going to get into mentorship and then not do it and still not step up? A lot of you are afraid to figure that answer out, to learn the truth and say, wait, am I going to get into a program where somebody spend one-on-one time with me and the truth is I'm afraid and I just won't move because I'm stuck in fear? But you should face that. But still, your worst case scenario is not that you get in and don't get knowledge. You will get the knowledge. And eventually, when you get out of fear and replace fear with knowledge, you will get the result. Good luck. Because like I said, some people suck at this and they still become millionaires because they fail forward. So it becomes, to me, riskless from that standpoint. Whereas real estate, you could lose money, man. You could lose money. So Antonio said, be more afraid of staying broke for the rest of your life than get rich quick schemes. Definitely. Be more afraid of staying broke And real estate is not a get rich quick. Real estate is a build wealth in whatever time it takes, by whatever means necessary, to build wealth for you and your family. It's a generational wealth play. It's not a get rich quick. It's not even a get rich, because you don't get rich from real estate. You get wealthy, and you get tax write-offs and benefits. So it's a get wealthy play. If you're more afraid of a get wealthy play and financial education and financial freedom play than you are the 9 to 5, then stay and deal with the consequence of the 9 to 5. It's unfortunate, but some of us have to live that lifestyle. I'll be increasing my cash flow by 3% annually, being an owner. Brian is accessible. Thanks for the info. Yeah, it'll be different next year. It'll be, yeah. I mean, more cash flow, more knowledge, more wins. That's what this is about. But guys, you got me on a rant. Now we're bumping up against an hour and a half. It looks like we're all out of questions, comments. So share this with somebody that you want to help. I'll see you guys on the next one. And stay tapped in. Stay tapped into this real estate. Get yourself a deal this year. We're halfway through the year. So if you haven't got a deal done yet, let's get it. The clock is ticking. We got to get a deal under your belt this year. We got to take that first foot, that first step out of the 9 to 5 this year. Whatever that income goal is, 10,000, 20,000, write it on the wall, write it on the whiteboard, text it to yourself. Look at that number every day and start taking action steps towards that number. Even your first $500 a month in cash flow gets you closer to that number, to that goal. It changes your mindset. Today, this year is the year. By next year, rates will be down. You have missed it. Stay tapped in. Brian Grimes, your real estate mentor, signing off.